This is my last market update for 2023, and I thought that we would take a step back and consider what the status is of the markets that we have been tracking, in particular the S&P 500, and we'll take a quick look at the NASDAQ, consider what the status is of those markets as we head into the new year. So here is the chart of the S&P 500. I'm working with SPX data. This is a weekly chart, and this is one of the analyses that we've been tracking for a long time in these market update videos. I try not to repeat myself in every single video, and so if you are not familiar with this analysis, I would encourage you to take a look at previous videos in the market update series so that you have an understanding of what this analysis is telling us. The important things about this analysis are that I have positioned a long cycle trough, in this case it's a trough of the 9-year cycle, in December of 2018. That raises a few questions, of course, because of the fact that we experienced a lower trough in March of 2020. I've mentioned this in previous market update videos, so I won't dwell on this point, but I do often refer to the March 2020 trough as the pandemic trough. Because of the pandemic that was sweeping around the world at the time, I believe there is the possibility that this strong move down and then bounce back up again are a distortion caused by the news events happening at the time, a fundamental interaction, which is the term that Hurst applied to times when news events around the world have an influence on price action. And the influence of a fundamental interaction can be seen in price action as volatility. In other words, price moves down more strongly than might have been expected and then bounces back up again, or vice versa, of course, but does not significantly change the cycle analysis. With the 9-year cycle trough in December of 2018, we have this trough over here in October of 2022, which I've been speaking about for a long time as a trough of at least 54-month magnitude. This has been my preferred longer-term analysis of the SPX for a long time now. We then had an anomaly in October of this year, which is this trough over here. And it is a discussion of that trough that is going to provide us with an understanding of what to expect as we head into 2024. So let's consider the possibilities in terms of what happened with the October 2023 trough. The first thing to notice, and the reason why I describe the trough in October of this year as an anomaly, is that 378 or 380 days elapsed between the trough in October of 2022 and October of this year. It's, in other words, just a little over a year that passed. Now, you probably know that the nominal model that we work with, which is simply a list of cycles that Hurst discovered 50 years ago active in these markets, and which we have a great deal of evidence are still active in this market, does not include a 1-year cycle. It includes a 40-week cycle, which has an average length of 272 days, and it also includes an 18-month cycle, which has an average length of 546 days. So where does a 375-day cycle fit into that picture? That is why this trough is an anomaly. There are 3 options, or 3 ways of explaining the recent price action in terms of Hurst cycles. The first option is presented on this chart. This option presents the possibility that the 40-week cycle trough occurred as a straddled trough. A straddled trough is simply a subtle trough. In other words, price doesn't move down very strongly into that trough and bounce strongly out of that trough, which makes the trough difficult to recognize. Straddled troughs are often witnessed in financial markets, and they are often described in other cycle approaches as inverted cycles, because when a trough is expected, we find a peak forming in the market. Inverted cycles do not exist in terms of Hurst's approach to cycles in financial markets. There isn't time to discuss that in today's video, but it is an interesting subject for discussion, which I will do a video about coming soon. In fact, in 2024, we have several new series of videos which we are planning to release, and certainly inverted cycles are going to be a subject that will be covered. But what does a straddled trough for the 40-week cycle mean? What it means is that the trough that formed in October of this year has then been phased according to this analysis as a trough of the 20-week cycle. This, as I've mentioned, is only one option. We're going to label it option number 1. The difficulty with this analysis, or the anomaly in this analysis, is that price has bounced so strongly out of that 20-week cycle trough. It's all very well to have a straddled 40-week cycle trough, but then the following 20-week cycle trough should not create quite such a strong bounce. And so there are certainly some question marks surrounding this option. One possible explanation I should point out for why price is bouncing so strongly out of the 20-week cycle trough is the possibility that this is not a genuine bounce. What do I mean by that? You will notice this price peak over here, and price is heading up towards that peak. Previous price peaks are, of course, very much like magnets. They draw prices to them. I was speaking just the other day to a very experienced Hurst cycles analyst, and he mentioned the work of David Weiss, who sadly passed away a year or two ago. His website was, and still is, I think, Weiss on Wyckoff, and his work referred often to the idea that previous price levels will provide good trading opportunities, because price will have a tendency to reach up to that level, possibly pass it ever so slightly, and then provide the trading opportunity for when the market will turn. So it is possible that this bounce out of the 20-week cycle trough is not purely fueled by the cycles influencing this market, but that is pure speculation. We will take a look at the other options in a moment which deal with that anomaly, but let's, before we do that, consider what this option implies. As you can see, we have some very neat nests of lows at the foot of the chart. In particular, this nest of lows for the next 18-month cycle trough is found towards the end of February. Displaying this cycle analysis as semicircles on the chart gives us a very clear idea of the regularity of the cycles in this analysis. And this is one of the reasons why I really appreciate and enjoy this analysis and continue to consider it seriously. You will notice that these 18-month semicircles are indeed very regular. They have about the same height and they have very equal wavelengths. The same is true even for the 40-week cycle semicircles. And so this option tells us that although price is bouncing very strongly out of a 20-week cycle trough, we need to keep an eye on the end of February, where we are expecting an important cycle to form a trough. In order for a cycle to form a trough, it pretty much needs to turn down, unless, of course, this 18-month cycle trough turns out to be straddled itself, but that is unlikely. But now, a couple of months ago, I posted a bearish long-term outlook, and does this possibility change that? Let's zoom out a little bit to consider that. I've changed the time frame on this chart to a monthly chart and zoomed out a little bit, and I would like to point out why a long-term bearish outlook is not at odds with this particular analysis. You will know, of course, that cycles form M shapes in markets, and so here is the first half of the M shape for this 9-year cycle, which I've mentioned formed a trough in December of 2018. Of course, there was the pandemic distortion right in the middle of that first part of the M shape, but it is clear that this first half of the M shape is a bullish shape. We experienced a late peak, and we experienced a trough in October of 2022 that was much higher than the trough in December of 2018. By definition, that is, of course, a bullish cycle shape. The shape of the next cycle, in other words, the next 54-month cycle, will be determined by the underlying trend. So what is the underlying trend of the next 54-month cycle? The 9-year cycle, as you can see from this semicircle, is going to be turning down, providing the possibility of a bearish underlying trend. What about the next longer cycle? Well, I have not included that in this analysis. If the 18-month cycle trough also formed in December of 2018, then the 18-year cycle would still be heading up, which would provide us with a neutral underlying trend for the 54-month cycle. If, however, the 18-year cycle would be better placed in the trough of 2009, then the 18-year cycle will be heading downwards, adding bearish pressure in the underlying trend for the 54-month cycle. And so we probably have either a neutral or a bearish underlying trend for this next 54-month cycle. If we have an entirely neutral underlying trend, then a very approximate expectation would be to see some kind of symmetry here. In other words, we would reflect the first half of the M shape into the second half of the M shape, providing us with a neutral M shape. I think you can see why my long-term outlook for this market is still bearish. Price is heading up to a second peak. It is so far looking fairly symmetrical. It is going to form this second peak sometime, probably fairly soon, and then it is going to turn down. What if the 18-year cycle is providing bearish pressure? In that case, we would have a bearish underlying trend, and the outlook is going to be not so much for a perfectly symmetrical move, but in fact a more bearish one. But now I have mentioned that this is only option 1. Let's consider option numbers 2 and 3. Switching back to a weekly chart. Option number 2 is that the 40-week cycle trough came in very late, and that 40-week cycle trough was not in fact straddled, but should correctly be phased over here. As I've already mentioned, the 40-week cycle averages a length of 272 days. So at 375 days, that 40-week cycle trough would have come in 100 days late. That is not impossibly late, but it is unlikely, particularly because of the fact that this trough in October of 2022 was a trough of at least 54-month magnitude. Following a high magnitude cycle trough, we expect cycles to run short as opposed to running long because of the bullish underlying trend, which brings us to option number 3. Which is similar in some ways to option number 2, but a little more likely in my opinion, which is that the 18-month cycle trough came in early. I mentioned this in the market update. I think it was 2 weeks ago that I mentioned this possibility, and it is an interesting one to consider that the 18-month cycle trough has come in, and it has come in very early. I think that many Hurst cycles analysts would disregard this possibility, but as we approach the new year, I do think it's important for us to bear it in mind. How does the possibility that this is in fact an 18-month cycle trough change our outlook for what we are expecting? First of all, what about this very neat nest of lows over here for the 18-month cycle trough in February of next year? If the 18-month cycle trough has already formed, then of course it should be better positioned over here. I'll draw those diamonds in manually. And so in that case, what is the trough that will form towards the end of February next year? That trough will only be a trough of 20-week magnitude. I say only. A 20-week magnitude cycle trough is nevertheless a fairly important cycle trough, depending of course on the time frame over which you are trading. And so we still need to be aware of the fact that a 20-week cycle trough, or at least an important cycle trough, is going to form towards the end of February next year. What are the implications of options 2 and 3 on the longer-term outlook that I presented a moment ago? This is where it becomes interesting. The fact that the 18-month cycle trough might have formed, and that supports the idea that we have a bullish underlying trend because early troughs imply a bullish underlying trend. So it tells us that the bull is still alive and well. But does it change the longer-term outlook? In my opinion, it doesn't. The possibility that an 18-month cycle trough occurred early simply reminds us of the fact that we have a good deal of bullishness in the market because of this 54-month cycle trough. But in terms of the much longer-term outlook, and I'm speaking several years in advance, so for the trolls out there, don't remind me of this bearish outlook next week. We're looking many years in advance, and the longer-term picture is still for the markets to turn down and turn bearish. To wrap up this video, we're going to take a quick look at the NASDAQ. Many of you might be asking, why am I not positioning the 9-year cycle trough over here in 2020 in the S&P 500? I've discussed this in previous market update videos, but it does bear repeating. In the NASDAQ, as you can see, we actually had a lower price in December of 2018 than we did in March of 2020. And so positioning that 9-year cycle trough makes much more sense in the NASDAQ. Here too we have a 54-month cycle trough that formed in October of last year. We have exactly the same anomaly with the trough that formed in October of this year. Again, this analysis shows us a straddled 40-week cycle trough, with the October trough phased as a trough of 20-week magnitude. But we have the same options available to us here. This is, of course, option number 1. Option number 2 is that the 40-week cycle trough occurred late, and option number 3 is that the 18-month cycle trough occurred early. You can take your pick, but the longer-term analysis, as we consider what we are looking at in terms of entering the new year, is still for markets to come up and form a peak. That peak would be the second peak of the M shape, after which we are expecting the markets to turn down. As a final comment about the possibility that an 18-month cycle trough did form in October of this year, which will give us a little more bullish pressure as we enter into the new year before the markets turn down, I would like to point out two interesting analyses. The first is in gold. This is a chart from our Hurst signals service, which provides an overview chart. I'm not going to go into the detail of this analysis, but here you can see a 9-year cycle trough positioned in September of last year. This is the same very big, important cycle trough that we've been looking at in our recent market update videos about gold. But note the interesting position of the 18-month cycle trough, which has already been found and positioned on the chart. And that trough was, of course, at the beginning of October this year. It makes for a very short 18-month cycle, of course. But we do expect the cycles in gold to be different to the cycles in the stock markets. And you will notice at the foot of this chart, at the right-hand edge, that we have consistently shorter cycles running in this analysis, working with, as a matter of interest, the nominal model created by John Eastreich, a very experienced Hurst cycles analyst who sadly passed away several years ago. But he published a nominal model that he worked with very successfully over many years for gold, which involved shorter cycles, as you can see at the right-hand edge of this chart. And a final chart for us to look at as we draw this video to a close. This is an analysis also from our Hurst signals service of the euro to US dollar. As you can see, it has positioned a very long cycle trough over here in September of last year. I would encourage you to go and take a look at our Hurst Cycles Notes service, the analysis service, where we publish newsletters in which I published a long-term analysis of the euro to US dollar and discussed the nominal model, which you will notice from the wavelengths at the right-hand edge of this chart is different to the usual nominal model that we use to analyze stocks. I discussed the possibility that a very long cycle trough had formed in September. I published that analysis in November of last year, I believe I'm correct in saying. Nevertheless, I had fairly early on identified that this was a very important trough that formed in the euro to US dollar. The interesting thing is that, again, we have an 18-year cycle trough that has formed in the euro. Now, although there is not always a direct correlation expected between the euro and gold and the US stock markets, there is, of course, the principle of commonality that Hurst defined in the 1970s that tells us that all markets, all financial markets, move with a great deal in common. And I think it is very interesting that these two analyses have positioned 18-month cycle troughs in October of this year, and it increases the possibility that we have recently experienced an anomalous and very short 18-month cycle trough in the stock markets as well. And so as we head into 2024, we are looking at the bullish bounce out of this October trough to carry us, at least I would expect, to this price high here, probably a little distance further, after which we're going to be watching for a peak, and we're going to be keeping our attention focused on February to see what kind of a cycle trough prices form at that time. In the back of our minds, we need to be aware of the underlying trend of these cycles, which will be turning down. I do hope that you found this market update useful and interesting. Have a wonderful festive season over Christmas and the New Year, and I will see you in January of 2024 with an exciting new series of videos.